This is Edmund Shing, and today we're going to look at oil and gas. So, a game of two halves for the oil and gas prices. We're then going to look forward, and then we're going to come to some conclusions about why you should still be invested in oil and gas stocks today. Oil and gas, a tale of two halves. Here on page 4 we look at prices of crude oil. The yellow line is West Texas crude, the black line Brent crude. As you can see, from January up until the end of June, typically we saw higher prices in crude oil. However, on page 5 we see what has happened in the second half of this year, which is the reverse. A sharp fall in Brent and West Texas crude oil prices, really from the end of June until today. Interestingly, here on page 6 we look at natural gas. This is the yellow line. We can see that natural gas prices, having fallen sharply until late July, have actually been steadily rising, and we would expect crude, which is starting to find a bottom, to perhaps follow as we head into winter time. Here on page 7 we can focus on two ETFs, exchange traded funds. The black line represents the energy ETF in the United States. The yellow line looks at the First Trust gas ETF. So this is an ETF of gas related stocks, and as you can see, since late June this has fallen by 19%, so it's been a very sharp faller. It has actually fallen a lot further than oil stocks. But again, remember that seasonally, as we go into winter, gas prices tend to rise, and so this may be the bottom already for this gas related ETF, and it may be ready to rise. So let's look at demand. World demand has been steadily rising for the last few years, in recent years driven by growing demand from emerging markets such as China and India. At the moment, however, you can see in the short term there is an imbalance of supply and demand. Oil demand has actually been going down slightly as we are going into summer, while oil supply has continued to grow. Why has it grown? Well, because of very sharp growth in shale oil produced by the US, where we can see that now oil production today is higher even than the previous peak in the 1970s. OPEC oil production hasn't actually been starting to fall. Saudi Arabia last month cut production by 500,000 barrels a day, and I would expect Saudi Arabia to cut production further going forwards to support oil prices. In fact, if we focus on this chart on page 13, the blue bars represent the difference between world supply and world demand. At the moment there is more demand than supply, so even though prices are falling, we are seeing more demand than supply right now, which should be good for prices going forwards. Just to show what's happened in previous winters. Each of the last few winters, gas demand, as you would expect in the US, has gone up sharply as it gets colder and people need more heating. Last year, as an example, this resulted in a 70% jump in the price of gas from bottom to top. Now, we would not expect the same size of jump this year, but we would expect a jump nevertheless, given that gas is at relatively low prices but has been rising steadily for the last few months. And again, just to come back to this gas-related ETF, we can see that it has been underperforming the S&P 500 index for the last couple of months, but that this relative performance is now starting to change, as you can see by the bottom part of this graph. The gas ETF is starting to outperform finally. So, a game of two halves, strong in the first half, oil and gas prices weak in the second half. We think you should be buying oil and gas exposure because the seasonal effects are very positive, and you can use ETFs to do this. This is Edmund Shing from BCS saying thank you for watching.